But if there is a recession, the miners keep on producing and you have oversupply and the price drops 50%. At that moment, that's a great risk and reward. I do research, I look at more than a few thousand stocks every year. Risk is a function of price. Also, especially with gold miners, the capital allocation there has been terrible. I don't really look at stock prices going up. I look at the value creation from the business side. And over the long term, that compounds. And I was really thinking about it a few days ago. My mistake was that...
All right, today we're having a discussion with Sven Carlin, the mastermind behind the Value Investing with Sven Carlin Ph.D. YouTube channel, as well as the founder of the Sven Carlin research platform. Great to have you on the show, Sven. Thank you so much for taking the time, and love to pick your brain on value investing, current opportunities in markets, etc.
Great to be here. Thank you for having me.
Excellent. All right, I would love to start off with your recent video, actually, the 44-year-old stock market super bubble. I think it's a great video. I will link to it down below and I recommend everyone to check it out. But there in that video, you actually talk about the price to earnings multiple expansion we have seen in recent decades. Perhaps you can shortly take 1 or 2 minutes to quickly explain what it's all about, and then I'll pick your brain and try to extend that video a bit further.
So the 1980s, begin 1980s, interest rates were up to 20%. It was normal also in Europe to take a mortgage with 15% interest rates. And since then we have had a decline from 20 to almost zero. I remember when I was living in the Netherlands, I thought that the 3% 30-year mortgage that I took was expensive, but I took it because at the end it was free money. So we live in an era still full of free money. And when you have free money, simply the value of asset prices goes up. That leads to crazy behavior, betting, and it seems like nothing can go wrong. And people need just to know that this is the result of all the money in the system and therefore a bubble.
Exactly. And based on the premise of the video, I was doing some rough napkin maths myself. So in the video, you explained that we've seen roughly a 60x return on the S&P 500 since the 1980s. And if you then account for a multiple expansion on that PE, price to earnings multiple, from 8 to 30, you would have to take away 3/4, which leaves you with about a 15x return. Now, if you actually start off with inflation-adjusted returns, we only start with a 15x return over that 44-year time period. If you then take out 3/4, you get to a 3.75x return in 44 years, which doesn't seem that appealing to me. Only a 4x return based on constant currency and constant multiple returns. First off, is that a correct extension of your premise in that video, using those inflation-adjusted returns? And now, what does that tell investors?
When you mix inflation in it, then everything gets distorted, because we have inflation that is measured by the government and we have inflation that is out there. If you want to buy a house now compared to, 10 years ago, the price is double. So that is not 1% inflation per year, that's a little bit higher. So some things, and then the government just structures it and measures it differently. But inflation is a component of investment returns. And if you look at some researches over the last 100 years, 99% of stock market returns was from inflation and dividends. But at the end, we have to invest for that. We have to invest so that we are covered for inflation. And then we have the return coming from dividends and perhaps some growth if you get the right thing. But you can always manipulate these things over time and check, but it also depends on what you are buying, and always, okay, what's the alternative? Not investing? Then you are surely that you will lose 90% of your purchasing power. At least by investing, you protect yourself in some way from inflation. And putting inflation into the equation makes it complicated, because you don't know what will inflation be in the future. So maybe it will be 10%, maybe it will be 4%. And therefore, I just accept it as a given. It will be. We cannot predict what. So I better position myself so that whatever it is, I am at least protected from it.
I think that's a great point. Like you said, what is the alternative? If you put it in bonds, you'll get maybe a 5% return now in the US. That's definitely also being eaten away by inflation. So great point there. But this does take me back to passive investing. Is it really a kind of a greater fool's game now with multiples so farly stretched and therefore also the risk of passively investing increasing so much? Is there significantly more risk attached with passive investing than the bogleheads make it out to seem nowadays?
Risk is a function of price. And if the price is 7 times higher than what it was 15 years ago, it mathematically means that your return is now 15% of the potential return than it was 15 years ago, and your risk is 7 times higher. That is just pure mathematics. If you pay more, the risk is higher and the return is automatically lower. And that then leads to the stupidity in the market of pay whatever price, it doesn't matter. Well, it matters. That's it. So at the end, now the dividend yield is 1.3% for the S&P 500 and everyone is happy. Why? Because it just keeps going up 10, 20, 50% per year. And as long as there is liquidity to make it, to keep going up, great. And there is this always joke on Wall Street, everybody is buying something, it goes up, 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 and up. And they all say, oh, when it starts going down, we will sell. And then you call your broker, oh, sell everything. And the broker responds, to whom? Because now everybody's pumping it up. If that reverts one day, I hope it doesn't, but if it reverts, to whom are you going to sell an asset that doesn't have a yield? You need to make money by selling it to someone in the future. And that is the key risk.
Yeah, it makes complete sense. And kind of this logically leads me towards Graham and Dodd, Warren Buffett style value investing. And I suppose that has done for you the same if we go by your YouTube title of your channel. Perhaps we can get started talking about value investing. What does it mean for you? And who are the greatest examples you take inspiration from? Is it the Graham and Dodd style value investing? Is it the Warren Buffett? Maybe some more modern examples like Peter Lynch?
Depends on where we are and where are the opportunities in the market. If the opportunities are on net cash flows like Graham and Dodd, which we haven't seen for the last 10 years because of all the asset bubbling, it's really hard to find a book value net bargain that is insanely cheap. So that gets hard from that perspective. Then you need to diversify. And then again, you are buying the bad and the cheap. So it is a strategy. It likely works over time, but it is a hard strategy. Then we can go to Warren Buffett. That is, again, prudent, buying great businesses when the price is right. Again, the price. Warren Buffett bought Apple 10 years ago, and he now sold Apple because the price is 10 times higher, and especially in the last few years, Apple didn't improve to justify the stock price. Also, Peter Lynch earnings, but a value investing approach is a bottom-up approach where you look at a lot of things, and from looking in detail at a lot of things, you select a little bit that at that moment fits your investment requirements.
Great point. Taking inspiration from all of them and trying to implement it in the current market cycle where you can find these opportunities. You talk about risk versus reward a lot. I believe you also have a quadrant now on your YouTube channel where you plot companies on that. Perhaps you can highlight a bit what it means to you and also explain to the viewers at home how they're not always correlated with each other.
So when it comes to investing, to allow for compounding over the long term, you must not lose money. If you lose 50% in 1 year, you need to make 100% to cover that loss. and making 100% is not easy. So when it comes to investing, we first, as value investors, must focus on risk. And then the question is, okay, what can go wrong? And then you create different, you don't know what will happen. Anything can happen. You create different scenarios. Okay, this can go wrong, this can go wrong, this can go wrong. And the best value investment is, okay, if that goes wrong, I'm still okay compared to the price. Then you know, okay, worst case scenario, I don't know, I make 2% per year. I don't lose money. And when you have such, let's say, a low risk situation, okay, I make little, but I don't lose money. And then there is always the scenario, okay, if this happens, I can make much better returns. So you first are trying to find the lowest risk. And then if you limit the risks in somehow, then you can leave room for the reward and the upside. So in this market, with all the bubbles, people are chasing rewards. Therefore, you see private equity booming with leveraged investments, buying things all around that have no mathematical, they have mathematical sense for them, but no investing sense, because if the market turns on them, they go bankrupt. But they don't care because they get bonuses at the end of the year. And therefore, as value investors, we don't want to take such risks, because I have to invest in 5 years, in 10 years, in 20 years, and I need to compound. So I first focus on risk and then leave the compounding for itself. And then
Excellent.
where you find it depends on the market.
Yeah, of course. I think that's a great overview. Definitely the focus on risk and decreasing it as much as possible. Perhaps we can also talk about rewards, because of course that is why people start investing, to get that reward for taking the risk at some point. What do you think is a reasonable reward to demand or look for as an investor?
So as a value investor, here you see, okay, in what market we are now. So in the current market, people focus on rewards. What is the reward? 40 years ago, people focused on capital preservation. For example, this is a story always Nassim Taleb discusses. If you're a dentist, you should focus on drilling teeth, improving your business, and that will be your reward. Not making money on financial markets. So we have now dentists, bakers, whomever, who is chasing rewards on financial markets and creating crazy pricing and situations. And then again, the reward, you have the business, that's the yield, that's the dividend, that should be the reward. Perhaps it will grow over time, then that improves the reward. But then again, we go back to the risk side, which is connected to the reward side. And then you say, okay, what are the chances of that reward materializing or not? So the mindset is not to chase rewards, because that increases the risks. Is really focusing on the risks, building something that will preserve your wealth over time. And usually by doing so, you also increase your wealth over time. But that's not your first concern.
All right. First concern should be not losing money. Rule number 1. Noted. Perhaps we can also talk about margin of safety for a bit. It's not a term I hear you say a lot. How do you view upon the margin of safety, and how does it fit into your strategy looking at markets?
Again, we go back. Margin of safety means, okay, if things go wrong, how am I protected? And then you look maybe at the assets of the company. Can the company be sold? Maybe it has a brand that has value in whatever environment. And then you think, okay, this cannot be any cheaper. Nothing can make it cheaper. All the bad news are already implemented there. And that leads then to a margin of safety. And then you also need to think, margin of safety doesn't mean the stock cannot go lower. Any stock at any point in time can go down another 50%. But I'm thinking, okay, in the next 10 years, I should be able, whatever happens, to get my money back because of the value that is there. And then there are different forms of margin of safety. can be assets, can be cash flows, can be contracts, can be the value of, I don't know, the land there, the buildings, etc.
Of course. All right. Yeah, it definitely seems to be a trend in my value investing journey that whenever I find a great opportunity and I buy some, it dips significantly lower. That's definitely a trend there. Perhaps we can talk about your research platform real quick. I referenced it in the intro, and it's of course something you manage. What is it all about?
I've started it in 2018, and that's I do research. I look at more than a few thousand stocks every year. Of course, most of them, like Buffett, in 3 minutes, it's not for you. But then on the interesting things, I dig deeper. And if it is interesting, then I put it on the covered stock list. So it's my covered stock list. I follow, now we are around 30 businesses closely. And then depending on opportunities, we go into the sectors that are cheap. And for example, last week I researched all the stocks traded in the US from Brazil and looked at all of them. And then there is this one Brazilian company that owns land that is now cheap as the food sector is getting cheap globally. People were exuberant 2 years ago and now they are very pessimistic. So that's a pocket of the market that's getting cheap. And then you think, okay, margin of safety, you will likely eat tomorrow. I don't know whether you will use Bitcoin, but you will likely eat tomorrow. And therefore, there is some long-term protection there. And I've looked at that. It is interesting, not yet at the price that would be interesting to put into one of my portfolios on the research platform. And then I put it on the covered stock. When, for example, I said if it drops 30%, that's Brazil Agro, it's a land-owning company in Brazil, we can start by maybe including it in the diversified global portfolio where I manage by request 20 position portfolio. If it gets better and it has a margin of safety, which is questionable because it's still Brazil, so unlikely that it will go into the model portfolio, but it's interesting for the diversified portfolio, and a model portfolio is one that is more concentrated.
Okay, and perhaps we can talk about that model portfolio. I believe you have been running that for the longest now. How does it work and what are the returns like?
So I started it in 2018 and the goal was to buy businesses across the globe that have a 10% or higher business yield, where the value created by the business is 10% or higher. And fast forward now 6 years, 6.5, almost 7 years, the return of the portfolio is exactly that, around 12% per year. And I was really thinking about it a few days ago. My mistake was that I started buying these businesses when the return was above 10%. Because as you said, you buy something and then the stock goes lower. So there was a lot of managing because the return can go from 10 to 15 to even 20% at some point in time. But still, if you buy businesses with a yield that have value creation over 6 years, that is the return, 12%. So now I'm a little bit more watching, okay, maybe we can push that to 15, wait a little bit, play around a little bit, so avoiding mistakes, and maybe it will be better than 12%. But there are businesses, and the focus is, I don't really look at stock prices going up, I look at the value creation from the business side. And over the long term, that compounds.
Yeah, really look at it as a business owner and try to get that business yield. Makes sense. Is that portfolio allowed to hold cash as well?
There is no cash, because I say let's fully be invested. I assume people have their own cash on the side, which should be then separated by the let's say financial investment portfolio that you have. As they always say, invest in stocks only the money you don't need, and therefore I manage it like mostly fully invested, and we buy something each month what is cheap at the moment. So European telecoms were very cheap at the beginning of the year. Now they are not that cheap, but there is still something. But food is starting to get cheap across the sector, and now we are increasing the exposure slowly there, and that's how I manage that portfolio.
Yeah, and would you run it differently if you ran it for your personal investing journey? Would you then have, would you feel the pressure to always be fully invested, or would you be okay with holding a cash buffer at times?
I have, so this is the model, and the diversified portfolios are made for the research platform. So anyone can pick whatever they want. And I also share what I own personally. And that is, then I always say, there is no strategy. This is just personal, how it fits me best and how I manage my wealth. And when it comes to me personally, cash is not something that I like to sit on, because it simply loses value. And if I do the work, I should be able to find something where it can be put to work. And then for me personally, I invest most of the money I make every month to compound that machine. So every month I try to buy something, and in that way build, let's say, my nest egg.
All right, great. And perhaps we can talk about code tailing, which to a certain extent this research platform would be. What is your general stance on code tailing, where you follow the code of a great value investor, like for example Warren Buffett, through 13F filings? What is your general stance on that?
I'm not really following Warren Buffett. We always look what they do, why Seth Klarman bought this, why this and that. However, first and foremost, Warren Buffett sells, or Berkshire sells 9 out of the 10 positions. So they use it, okay, this is now cheap, let's buy it, and let's do the analysis then. Let's maybe talk to the management. And for example, Berkshire bought Ulta, the beauty retail store in the United States, a few quarters ago, and then sold it immediately after 6 months. And if you go through Berkshire's holdings, now they buy 10 stocks, and after 2 years, 9 of those 10 are gone. So they test the waters, likely see how it feels owning, and then they decide, okay, we are going to go deeper, and then they often buy the whole company, or we sell it and forget it and go to the next one. Then you have others that you don't know. You know the position because they need to report the long position, but you don't know the structure around it. For example, Seth Klarman recently bought Dollar General, and he has to report, I bought Dollar General. But you have no idea, as he's a specialist on bankruptcies, bankruptcy debt and everything, you don't know what are the bonds that he is owning, what is the hedges that he is owning on that. So you cannot really make decisions on 13Fs. You can look and research based on that information, but not really just follow blindly what they are doing.
Yeah, no copy paste, but it can be a great inspiration for finding the next value investment if you do your research.
Yeah, can be, because here and there you find something.
Yeah, exactly. Perhaps we can talk about some subsectors that are interesting. Of course, you referenced the value investors should inherently apply a bottom-up approach where you look at individual companies instead of a sector. But from time to time, sectors can be very interestingly valued, and then there might be a lot of value to be found in spades in that subsector. What is for you currently the most interesting sector? I think you referenced Brazil and food already. Are there any other ones, or maybe you can expand a bit more on that one?
So, for example, we really had this food price boom alongside inflation and underinvestment a few years ago, and stock prices went up significantly. And the market always tends to overshoot on the upside, but also overshoot on the downside. So now food businesses, if you look at the average cycle, are already delivering a free cash flow yield of 10%. then it is food. So if inflation is 2, 5, 10%, you can likely expect the same return. Nobody cares about food because there are other things in the market like AI or things like that where we will not eat likely in 10 years. It will be all cheap in our head on energy. So that's why it is cheap. And when something is cheap like that, you can start looking, you can start researching, perhaps buying something for a diversified portfolio, building a position, and then you're getting the dividends, reinvesting. And I think that if over the next 1-2 years, as the food cycle might be in a downturn, we can build a good position, that's always a great component to the portfolio that will bring dividends, and then you can then compound later on. And it has a margin of safety because I presume we are all going to eat in the next weekday, even a bit too much for me. I have to eat a little bit less, but okay.
Yeah, Christmas season is coming up, and everyone is gonna indulge in that, I suppose. Great, thank you for that. Perhaps we can also talk about the oil sector. Some very smart people like Rick Rule claim that that sector is underinvesting in maintenance capital to the tune of about $1 billion per day. Is that something you're currently looking at? Do you see value there? For example, Warren Buffett buying Occidental Petroleum. Is that something you're interested in?
So food is one of the sectors, and I have here on my to-do list to really dig into the oil sector and make a complete in-depth analysis, because oil is still used. However, now I think it's mid-priced. If you look at things at the supply and demand going into 2025, if we have no shocks, then the price of oil might go lower to 50. That depends how Saudi Arabia decides to open the valve or close it, because I think they are now producing 8 million barrels or billion barrels a day, and their capacity is 12. So they can manage that oil price at their wish, but for now they said they will increase production a little bit, maybe deviate from the dollar at 100 barrel, and with a little bit of panic, with a little bit of oversupply, oil can be at 50. And at that moment in time, when oil is at 50, close to the production costs, the market, what usually does, panics and oversells the opportunities. So over the next month, I will be researching oil stocks, we already have one, and then putting them into a list, see what should we cover, and then if oil goes cheaper, okay, we know already what to buy and increase the exposure to oil, because as you said, it is cyclical. Now businesses are underinvesting, which means if you have glut, then there will be scarcity at the moment because of in somewhere in the future, and then you can always play that oil cycle.
All right, great. Perhaps we can also talk about small caps. For example, the Russell 2000 index is underperforming the S&P 500 quite a bit. Still a good return in the last year, but underperforming there. Is there a lot of value to be found in small cap companies? Do you think that's an area that we should be looking?
I think I looked at every company of the Russell 2000, I think it was 2 years ago. I really went one by one. Then I selected a few, but they didn't really get my interest. So you have to check every company in the list, because small caps can look like underperforming the S&P 500, but if you do 20% and you are 100% overvalued and the S&P is 200% overvalued, you might be relatively undervalued, but from a fundamental perspective, you are still overvalued. And if you look at the American market in general, it's very hard to find value there. It's easier to find value there on foreign businesses that are traded on the American market, but really American businesses, stocks just keep going up, and I think they have now 65% of the market capitalization. So that's a difficult place to look for. There are some pockets, again, now food that we are seeing, etc. So likely some small cap with that, but then you have to really do, again, a bottom-up analysis, look one by one and see where you are.
All right. Great. Yeah, you could say it again. Finding it's hard to find value in the US, definitely. Also, something I would love to talk about with you is gold. That's something we talk about on the channel quite a bit, as that hedge against inflation potentially. What is your view on gold? How do you view it, and does it fit in an investing strategy for Sven Carlin?
So in 2017, 2018, I talked a lot about gold because the price was 1,200, the production costs were 1,000, and then I said, okay, whatever happens, this looks like an interesting situation because it's unlikely it will go much below production costs, and there is always the upside. Now gold is 2 times higher than what it was back then, so I don't talk that much about gold over the last 2 years because the price is double. And what happens when the price doubles? The risks goes up and the returns go down. And usually, whenever you think about something, okay, I need protection for inflation, okay, gold, and now everyone is thinking about that, now it's already too late. You already missed the 100% up. So it's always nice to think about these things when nobody wants to touch them. So 2017, 18, 19, nobody wanted gold. There were other things, and now it's getting again interesting because people are trying to protect from inflation. I'm not saying it's going to be bad, but I'm just saying the risk and reward is not attractive. Do I have a margin of safety? No. If people start selling gold, it can drop 30%. You can then have a strategy. Okay, if it drops, I increase my portfolio exposure. If it goes higher, I decrease, and then you get the yield on that trading. But as we know, gold doesn't produce anything. You can have a good strategy around it, but I prefer to own businesses that produce value.
Makes complete sense. And talking about businesses, potentially gold miners, we have seen that 2x move in gold in recent years. Seems that some gold miners, I mean some majors have doubled that as well, but some medium to small size miners haven't really done that same return. Would that be an area where you would be interested to look for value, or is there too much risk associated with mining?
There is a lot of risk associated with mining because also, especially with gold miners, the capital allocation there has been terrible in the years, and there is more value destruction than value creation, because all else equal, if gold doubles, all gold miners should go up 5x, because gold prices go from 1,000 to 2,000 or double as they did. If they have, I don't know, at 1,200 gold, they have a 200 profit margin, gold miners should now have 1,000 profit margin. So they should be a 5x, and that didn't happen. Their profit margins didn't improve, and just a lot of bad capital allocation, acquisitions, things like that. So you really need to know your gold miner to dig into that. But then again, now with prices of gold much higher than production costs, those gold miners should be printing money, but then again, you don't know for how long that will be the case.
Yeah, exactly. And also, it's so hard to find a gold miner that hasn't ballooned their share count into oblivion in the same time period. So you have a rising cost and, of course, massive dilution. Something you've talked about in the past a lot is actually copper and copper miners. Is that something you're currently looking at, or is it just not the right time of the cycle?
All the commodities, if we go into an inflationary period, all the commodities should do well, but I don't know whether we'll have a recession first before going into an inflationary cycle or not. So copper, I would love to buy copper assets, but I need a recession for that. And here is the beauty of having a covered stock lists. If you have a list of copper, food, I don't know, something unrelated or something, then okay, now this might get cheap. Let's watch it. For now, copper, let's say, is mid-priced. It can shoot up on inflationary pressures and increase demand. But if there is a recession, the miners keep on producing because it's not easy to put a halt to producing, and you have oversupply and the price drops 50%. At that moment, that's a great risk and reward buy because we will need copper forever. There is a margin of safety, and that moment you can buy. So I'm just waiting for that. If it happens, great, I will buy. If it doesn't happen, okay, I don't have to invest in any opportunity out there. I'm just waiting for the right time. I did invest a lot in copper 2016, 2019 when it was cheap, and we did great. And also in 2020, September 2020, oil and commodities were cheap, so I remember buying Glencore, things like that. So it's just about waiting for the right opportunity. I wait for the opportunity to come to me rather than chase it, so I manage the risk.
Importance of a wish list makes complete sense, and I completely agree with you there also. Perhaps one more area where value can be found, at least if you listen to Sven Carlin, is mergers and acquisitions. Recently we've seen an example with SiriusXM that was a result of 4 different SiriusXM corporations actually merging. There was an arbitrage opportunity there potentially, and now afterwards you might be looking at a company that has a 10% plus free cash flow yield, and Warren Buffett seems to be buying. Is that an example of where value can be found easily, merger and acquisition, because it's so complex? And are you a fan of making use of arbitrage opportunities?
Now, I'm not really a fan of making arbitrage opportunities. We bought Sirius for the diversified portfolio, so we follow also that. As you say, the cash flow yield is above 10%. But the arbitrage opportunity was there from a situation, but you never know whether such arbitrage opportunities will the undervalued go to the higher valued, or will the higher valued go to the lower valued. And then also with arbitrage opportunities, yes, a company says, I will acquire this at this price, and then you buy it here, and in a year you will get that price. The problem is, like it was with Microsoft and Activision, so you don't know if Microsoft says, I will not buy it, you are left owning the business that will not be bought. Of course, Warren Buffett knew that Bill Gates will buy it, and therefore he did that kind of arbitrage, but I'm always looking at the risk. What if it doesn't happen? Am I happy owning the asset that isn't acquired at that price? Therefore, I didn't go into the Activision merger and arbitrage, even if it was a tempting one.
Yeah, that was definitely a tempting one. And with SiriusXM, it seemed that we saw actually the more expensive one go down rather than the cheap one go up. So yeah, that's a good caveat to add there. Perhaps the last area...
Warren Buffett and everyone they were just buying the cash flow yields there and the potential of that going forward over in the future. Not really doing merger arbitrage, because to do that you need to sell to someone, and Warren Buffett cannot sell 20% of the company to someone.
Yeah, it makes complete sense, and I believe he's a very large owner of SiriusXM as we speak, so it makes complete sense there. Perhaps the last area of where value can be found is companies that are trading significantly below book value. Sometimes I stumble upon a company that has a large cash balance, for example, because of a spin-off they've done recently, for which they got a large cash sum, isn't really being recognized by the markets. Is that something you would be interested in? Or because it is not really a business that's generating those cash flows, it's not really for you? You
need to know what the manager will do, what the owner will do. So there are some Chinese companies that are trading, I know, at $10 and have $12 of cash because they sold something. But if the management is sitting on that cash for 5 years, you have to ask the question, is that money, that value, for me as a shareholder or for them? they going to siphon that money out or something like that. And then you need to really watch what the management will doing, how will that manage their money. For example, Alibaba has 50 billion of cash on a 200 billion market capitalization, which means that you're practically buying it at 150. So for such a global company, that could be considered value. But on the cash side, they started doing buybacks, so they started rewarding shareholders, which is a positive. But you never know where will that cash go. So that cash needs always to be discounted in a way. And therefore you always look, okay, margin of safety. If that cash comes to me, great. If it doesn't, am I still okay? So that's also a question to ask.
Yeah, great point. I believe you have a lot of Japanese small caps that hold 2 or 3 times their market capitalization in cash, but in the local currencies that's being inflated away, and it's a family business, so they don't want it to go bankrupt, and they will never spend that cash or distribute it to shareholders.
So a friend of mine who analyzed Japan said all these businesses, the managers there own it so that they can own it for the next 100 years. And yes, there is the cash, but nothing will change from them keeping a 1% dividend yield and keeping the cash there in bonds at 0%, just sitting there as prudence, which is not bad. But again, it is the management there to maximize your value or not is always the key question.
All right, Sven, I think that's a great point to end it. Thank you so much for your time. Perhaps you can, for one last reference, share where people can find you, and then we'll end it off there.
So on YouTube, you just type my name on YouTube, or there is my website. It's not really a website, just with the links to my research platform. I have a free value investing course that I said this winter are refurbish it a little bit, so that's also something interesting. And then you can always send me an email, maybe you can put it here, investwithsven@gmail.com if you have questions about the research platform or anything.
All right, thank you so much. I will put those links in the description. Again, Sven, thank you for your time, thank you for your wisdom, really appreciate it.
Thank you, it was really a pleasure and a fun conversation. Thank you.